we've got to be looking at this market, paying attention to it. We might head lower here. If we do, we'll watch it. If we take out the previous lows, then I will start looking at the possibility we may be trending lower. But we're not trending lower yet. We're not. And so we got to be very careful. This has been a break of the trend. This has been a move lower, but it's nothing more than that at this point. We'll trade it, but we're going to trade it in very short-term type of trades, day trades and swing trades. That makes sense? All right. I was going to show you guys how we did the Apple trade here and show you what the structure of the trade was. And yesterday, you guys here in Dallas told me that you guys learn better with pictures than you do with words, right? Remember the Dr. Seuss thing that we talked about? Is that still the case? Okay, all right, so we're going to do a green eggs and ham kind of rendition here. Stocks trading at about, stock was trading at about $113 a share. We go in and we see that the stock starts to break down. Looks like it may head lower, so we come in and we buy to open a put option, right? We went in and we bought to open the 113 put, and we paid $2.31 for doing that. Okay, so we paid $2.31 for buying that put option. Now, if the stock goes lower, we'll make some money on this, correct? How low does it have to go? 111.69 is where it needs to go. 110.69. It needs to go 110.69 because to calculate our break even on a put, all we do is take the cost of the trade, okay, which is $2.31, and we subtract it from the strike price that we are buying. So we know at this point, for us to break even, this stock has got to move by Friday at expiration below 110.69. We know that. All right, so the stock's got to move a lot. And now the nice thing was that the stock did move. Okay, we got one. It went down. And it was going down, it went down, and Marquet was here, and actually Jed was sitting in the room. Marquet's husband Jed was in the room with us, and he was watching the presentation, and he's obviously over there trading, and he raises his hands and he says, Bill, Apple's now filled the gap. Okay, it had filled the gap for the day. Why is that important to know? Because that fill of the gap may act as an area of support, and the stock could turn around and bounce from there, which is exactly what it ended up doing. So Jed raised his hand. He said, Apple just filled the gap. And I told you guys, well, what do you guys want to do? Do you want to get out of the trade? Do you want to stay in the trade? We're at the fill of the gap, but the stock is going lower, and we're in a bearish market, but it is bouncing higher here at the gap, right? And so now we had a problem with we don't know what to do. So what we did is we took half of our position here. So we had 20 contracts. We went in and we sold to open the 112 put option. We sold it to the market maker for $2.52. But we did that on 10 contracts, not on 20. We did it on just half of the position. So now let's take a look at what we've done here. At this point, if the stock was to bounce and go higher, what would happen to both of our options? If this stock bounces and it goes higher and it ends up at 114, what happens to both options? They decrease, they go to zero, right? They both expire worthless. So I'm going to lose $2.31 here, but I'm going to make $2.52 here. I've completely neutralized the risk on half of this trade and even created about a 20-cent profit in this example. So on half the trade, I now have zero risk, which is where our focus should always be as a professional trader. I've neutralized half of my risk. Not only did I neutralize half of the risk, if the stock did not go sideways, down, but if the stock did not go up, but the stock continued to go lower, on half of the trade, I would make $1, the difference between the two strike prices and the debit spread, plus the 21 cents that I brought in as a credit, so I would have a maximum profit in here of $1.21 on this side of the trade on 10 contracts. But what about the other 10 contracts? What's my profit potential on those? Just depends on how far Apple wants to go down. If Apple goes down a lot, my profit potential is a lot. If Apple goes down a little, my profit potential is a little. But I have now laid off half the risk, generated a maximum profit, and generated off of that half of the position a guaranteed profit of 21 cents no matter what happens. So now how do I manage this? Well, we watched the stock this morning, and we said if the stock fills the gap, we'll take off the hedge. So we've got 10 contracts hedged. The stock actually gaps down and then starts to rally higher. When the stock fills the gap, we come in and we buy back these 10 contracts. Now you don't have to, but you could. We filled the gap. We watched the candlesticks. The next candlestick is a bearish candlestick and starts to move lower. It looks like the stock has recognized the fill of the gap. That happened yesterday, didn't it? Now coming up underneath the gap, we've filled the gap. That gap now acts as an area of resistance. The stock starts to go lower. We buy back the 112 put option. Well, hang on a minute. The stock's trading at 113. The stock went up. What's going to happen to the 112 put option? It decreases in value. In addition, we sold that hedge last night when there were 24 hours of available time to expiration. This morning, when we filled the gap, there's 6.5 hours minus whatever time it took to fill the gap. So what's happened to the time value in the 112 put option? It's gone down too. So now we can come in and buy back the 112 put option, and we might be able to buy that back for, oh, I don't know, let's say we buy it back for 50 cents. If we buy this back for 52 cents, it means we made $2 on our hedge. We now still have the 20 contracts left, and the stock is going down. That hedge not only protected us overnight, it gave us a profit opportunity overnight, and now we have full exposure to a stock that's going lower without being worried about losing time value on our options overnight, because the market maker is in the same boat we are with regards to time value loss. We buy an option on Thursday, we're like, crap, we're going to lose some option time value. I'm going to sell another option to the market maker. I just put that guy in the same boat. Now he and I are sitting in the same boat. We're just staring at each other. I'm losing some time value. How about you? You too? Yeah? All right. We're both in that same boat. How come we didn't do 20 contracts? Because in a bearish market, we think that the stock might potentially gap lower. And if it gapped lower a lot and started to run, we would just go ahead and take our maximum profit on 10 contracts, which we said here was $1.31, right? $1.31 was our maximum profit. We would take that $1.31 on those 10 contracts and be happy with it. But those other 10 contracts that are left out there unhedged, they have no cap on their maximum profit, right? So we're keeping an eye to risk, but we're maximizing our profit efficiency. $1.21 in this case, yeah. Okay? So that, guys, is how we would take advantage of scenarios like we had in Apple, where we had the fill of the gap here, okay? So we gap down, we come up, we fill the gap, get very close to filling, we throw this doji right here, then we start heading lower. This is the place to take that hedge off and then go ahead and let the stock come down and look for an exit on the trade.